If you sell real estate the normal way, the IRS becomes your biggest partner. A 1031 exchange is how property owners legally defer capital gains when they sell. Instead of paying tax, you roll the proceeds into another investment property. No tricks, no loopholes, just following the code exactly as written. This is why retiring owners don't cash out. They reposition. So what exactly qualifies as a 1031 exchange? Let's clear that up. A 1031 exchange is not about avoiding taxes, it's about timing them. You'll sell one investment property, buy another like-kind property, and defer capital gains. Like-kind doesn't mean the same use, it means real estate for real estate. That flexibility is why people upgrade properties instead of cashing out. But flexibility disappears the second the clock starts. The most expensive mistake in a 1031 exchange happens in the first 45 days. From the day escrow closes, you have exactly 45 days to identify replacement properties in writing. No extensions, no grace period. Most failed exchanges don't fail on price, they fail on timing. And timing is why the type of replacement property matters. Retirement doesn't pair well with management. In a triple net lease, the tenant pays taxes, insurance, and maintenance. You own the building, they handle the headaches. That structure fits perfectly inside a 1031 when owners want income without involvement, which leads to the real goal of many sellers. You don't need to sell to stop being a landlord. A 1031 exchange lets you exchange management-heavy property into low-involvement ownership. You keep cash flow, equity, and tax deferral, but lose the day-to-day work. That's a reposition, not an exit. And some owners take simplicity even further. If triple net is simple, ground leases are cleaner. With a ground lease, you own the land. The tenant owns the building, handles everything, and pays rent for decades. This is why retiring owners love them inside a 1031. But simplicity doesn't mean cheap. Let's talk numbers. Taxes don't just reduce profit, they reduce buying power. If you pay capital gains today, that money can't be reinvested. A 1031 keeps your full equity compounding. That difference can mean one property versus two. And that's why paying tax early hurts more than people realize. Once you pay taxes, that capital is gone forever. You can't leverage it. You can't earn income on it. You can't grow it. 1031 exchange preserves your equity and buying power, which matters most when you're planning for retirement. If you want to protect your equity and set up a strategy that actually works, call 818-430-8497 today. We'll walk through your options and make sure you don't pay taxes before you need to. Remember, timing is everything. Call before you sell, not after.